And that brings us back, inevitably, to leverage. Whether it's radio stocks or AI stocks.
Welcome to the Deep Dive. Today, we're really zeroing in on a pivotal moment, maybe the pivotal financial moment of the 20th century, the 1929 stock market crash.
Yeah, it's this massive event, not just a market dip, but something that really tore down the existing structure and, well, ushered in the Great Depression.
Exactly. And everyone kind of knows the date, 1929. But what we're finding in the sources is that understanding it is maybe less about dense economics.
And much more about, human behavior, greed, hope, fear. We're looking at some great archival stuff, including a book that frames it almost like a drama.
Like a character-driven story of failure, really.
Right. It paints the crash as this prequel to the 2008 crisis, and maybe, just maybe, a bit of a warning for today, too.
That's our mission here.
Yeah.
We want to pull out those almost cinematic details, the human stories from the archives, and link them straight to the feelings we see in markets now, that mix of, paranoia and promise.
Yeah, that's a good way to put it. We want you, the listener, to get not just the what happened, but the why it still matters.
Okay, so let's set the scene. We've got the Roaring '20s, this incredible feeling of optimism.
Almost feverish optimism, yeah. But the sources really hammer home that the whole boom was built on something new and shaky. A totally different attitude towards debt.
Right. Let's unpack that because it's huge. Before the 20s, taking out a loan, using credit day to day.
It was almost seen as, a moral failing, like a sin, socially unacceptable. Debt was for emergencies, for the desperate, not for getting ahead.
A very conservative mindset about borrowing.
Extremely. And then General Motors steps in. They had this light bulb moment. Cars. Cars. They realized they can sell way more cars if they just loan people the money to buy them directly. They set up GMACE, General Motors Acceptance Corporation.
And that just blew the doors open, didn't it?
Totally revolutionary for the time. Suddenly buying on credit wasn't shameful, it was American. It was modern.
So GM basically figures out consumer credit. You can use tomorrow's earnings to buy today's shiny new thing. And Wall Street's watching this.
Oh, absolutely. They see GM making money by lending money, and they think, hold on, we can do that faster, maybe riskier.
And that leads to this explosion of brokerage houses.
Yeah, the sources say they popped up everywhere, like Starbucks is the quote I remember. Suddenly, it wasn't just the Rockefellers playing the market.
Anyone could walk in. The dentist, the shopkeeper.
Pretty much. Your average person on the street could open an account and start investing, or maybe speculating is the better word.
And crucially, it wasn't just that they were investing, but how. This brings us to leverage, right? Margin buying.
Ah, yes, margin. This is the absolute core of why it became a disaster, not just a downturn. The rules back then were loose, very loose.
So you didn't need much cash up front.
Shockingly little. You didn't even need a bank loan in the traditional sense. The brokerage itself would lend you the money. You could put down, say, $1.
Just $1.
And they'd lend you maybe $10 to buy stock.
10-to-1 leverage. That sounds incredible when prices are soaring.
It felt like free money. You put down $100, control $1,000 of stock. Stock goes up 10%. That's a $100 profit on your $100 investment. You doubled your money instantly.
No wonder people got hooked.
Exactly. And that's why the market went absolutely parabolic between 1928 and 1929. Up 90%.
90% in about a year.
Yeah. It created this widespread, almost religious belief that stocks only go up, that the risk was minimal because tomorrow was always richer.
But the flip side of that leverage is brutal. If the stock dips even a little,
you're wiped out. Or worse, you get the margin call. The broker wants their loan back now.
And they can demand it back just like that.
Instantly. These were often call loans, callable at any time. If the stock price fell below a certain level, triggering the margin call, and you didn't have the cash to cover.
Which most people wouldn't, right, if they were leveraged 10-to-1.
Precisely. Then the broker had no choice. They had to sell your stock immediately at whatever price they could get just to get their loan back.
Which pushes the price down further,
causing more selling,
forcing more margin calls.
It's a death spiral. That feedback loop is what turned Black Thursday and Black Tuesday into catastrophes. Sheer leveraged panic.
Okay, so let's pivot to those days. The bubble bursts. The sources talk about this incredible failure of information. What did that actually look like? Forget the charts for a second. What was happening on the ground?
Oh, it's pure chaos. The scenes described outside the New York Stock Exchange, I mean, the technology couldn't handle it, the ticker tape machine.
The thing printing out the stock price?
Yeah, it just got overwhelmed by the volume of selling. The prices coming out on the tape were hours behind the real action on the trading floor, sometimes 5 hours behind.
5 hours.
Yeah.
So you're standing there, watching the tape, thinking you know the price.
But your stock might have already collapsed hours ago. Your entire fortune could be gone, and the official record hasn't caught up.
That's terrifying. An information vacuum.
Completely. You couldn't call your broker easily, lines jammed, you couldn't trust the ticker. People physically crowded into brokerage offices, onto Wall Street itself, just desperate.
Desperate for what? Just to find out.
To find out if they were ruined, to see a real number, to find someone, anyone, who knew what was actually going on. It was a breakdown of data, trust, everything, all at once.
And the human cost, I mean, the sources are quite graphic about the immediate fallout, the panic, the ruin.
Yeah.
Suicides.
Yeah, they don't sanitize it. And that brings us to maybe the most haunting anecdote, that story of the messenger boy.
The 11-year-old boy working on Wall Street during the crash.
That's the one. He saw something unforgettable.
He saw someone jump.
He watched someone jump from a building window. Right there. The direct, immediate, fatal consequence of financial ruin.
Wow, and he lived a long life after that.
He lived to 91. But that single image, that trauma, it shaped his entire financial life. The sources say he never bought a single share of stock ever again.
For his whole life, after seeing that.
Never. Only bought bonds, kept cash under the mattress. That one event instilled a lifelong aversion to the perceived risk of the stock market.
That story just perfectly captures it, doesn't it? The deep psychological scars, but also the themes the sources keep hitting on. Greed, this incredible overconfidence, hubris.
And that seductive belief that this time it's different, that the easy money train will just keep rolling.
Which is where we need to bridge the gap.
Right.
Connect 1929 to now. The sources draw a really interesting parallel with technology.
It really do. It's fascinating. Back in 1929, the hot sector, the thing everyone had to own, technology changing the world,
Was radio.
Exactly. Radio Corporation of America, RCA. People piled into RCA stock, believing it had limitless potential. It was the future of communication, entertainment. Sounded familiar.
It sounds exactly like the narrative around artificial intelligence today. NVIDIA, for example.
Precisely. The belief in exponential growth, a transformative technology justifying almost any price. It's the same speculative fervor, just a different object of desire.
But the sources raise a critical question about today's AI boom, don't they?
Mm-hmm.
Is it real? Sure. But is it also masking other things?
That's the worry. Is this dazzling tech boom hiding underlying problems in the broader economy? Just like the radio boom hid problems in 1929.
What kind of problems were masked back then?
Oh, major ones. The agricultural sector was in deep trouble throughout the 20s. Huge income inequality. Some core industries were hitting saturation points. The warning signs were there.
So economists and journalists saw this stuff? They were warning people?
Some were, yes. There were articles, speeches pointing out the risks, the imbalances, but
That party was too good.
pretty much. The sources call it hubris and selective blindness. When the market's making everyone feel rich and smart, listening to the cautious voices is like, well, it's hard. The optimistic narrative drowns them out.
It always does, doesn't it?
Yeah.
Until it doesn't.
Right. And that brings us back, inevitably, to leverage. Whether it's radio stocks or AI stocks, if the boom is fueled by too much borrowed money.
It's inherently unstable.
Dangerously so. Because when the sentiment shifts, even a little, the forced selling from those leverage positions kicks in, and a minor dip becomes a major crash.
It's that same feedback loop.
The exact same one. And the question the sources pose for any investor in any era is brutally simple. Can you get on and off the train in time?
And history suggests probably not.
History suggests most people get caught.
Okay, so let's talk aftermath. The crash wasn't just an ending, it was a beginning too, right? It fundamentally reshaped the relationship between Wall Street and Washington.
Oh, absolutely. The sheer scale of the disaster forced a massive shift in power. Suddenly, the idea of federal oversight wasn't just palatable, it was demanded.
And this led to those big reforms we still talk about. Things designed to protect the average person, the mom-and-pop investor, the next generation's messenger boy.
Exactly. You get the big three foundational pieces of the regulatory puzzle: the SEC, Glass-Steagall, and deposit insurance.
Okay, let's quickly nail those down for the listener. The SEC, Securities and Exchange Commission, 1934, its job.
Transparency and trust. Remember the 5-hour ticker delay? The SEC was created to mandate truthful disclosure from companies, reliable market data, fight manipulation, basically to prevent that kind of information vacuum again.
Got it. And Glass-Steagall, that's the one that gets debated a lot even now.
Glass-Steagall built a legal wall between the risky business of investment banking, the speculation that fueled the bubble, and ordinary commercial banking, where people keep their savings.
So your local bank couldn't use your checking account money to gamble on stocks.
That was the idea. Keep the risky stuff separate from the safe stuff to protect depositors. And then deposit insurance, the FDIC, guaranteed your savings up to a certain amount if the bank failed.
These were huge fundamental changes, bedrock stuff for decades. But the sources express real concern about where those guardrails are today, right?
That's a central theme, yes. We can analyze the policy mistakes of 1929, like Hoover's actions or the Fed's missteps, but the worry now is about the deliberate removal of safeguards we put in place because of 1929.
And the prime example is Glass-Steagall's repeal.
The effective repeal in 1999, allowing investment banks and commercial banks to merge again. Many argue that directly paved the way for the kind of interconnected risk we saw explode in 2008. It took down that wall.
Why? Why dismantle these protections that were born from such trauma? What's the driving force?
Well, the source puts it pretty bluntly. It's human nature again. Everybody wants the lottery ticket. Everybody wants access to more.
More yield, more profit, faster gains.
Exactly. There's constant pressure from institutions, from individuals for easier access to potentially higher returns, even if that means taking on more risk, which means weakening the rules.
Which leads to the fear that something 1929-ish, as the source puts it, could happen again because the system's buffers are being eroded.
That's the core anxiety.
Okay, so wrapping this up, what's the big takeaway for you, the listener, from this deep dive into 1929?
I think the fundamental lesson is how human emotions, fear, greed, overconfidence can interact with financial tools, especially leverage, to create catastrophe. The leverage didn't cause the initial wobble, maybe, but it turned that wobble into an earthquake.
Right, and the crash forced huge structural changes. Massive reforms were put in place.
That's the underlying psychology, that belief in the next big thing, that desire for the quick win, the lottery ticket access.
That seems pretty constant. It drives the cycles, doesn't it?
It absolutely does.
Right.
Which leaves us with a final, maybe unsettling thought for you to chew on based on everything we've discussed.
Go on.
If witnessing the ultimate human cost of a crash, seeing someone literally jump to their death like that messenger boy did, wasn't enough to stop him from fearing the market and leverage for his entire 91 years, what amount of regulation, what rule book can ever truly permanently stamp out that basic human drive for risky, easy money, especially when the guardrails themselves keep getting chipped away?
That is the question, isn't it? The 1929 dilemma is still alive and well.
Grab 1929 by Andrew Sorkin, now on sale $23.95. Don't miss this chance and build good habits and achieve remarkable results. Buy now, today.
Like and subscribe for more Bookhaven podcasts.